All right, hey there, everybody. It is just a few minutes after 11 a.m. Central Standard Time here on Tuesday, the 12th of April, 2022. I've got you with me and me with you, I guess, here on an overcast and somewhat rainy, Bernie morning. I'm Chris Franks with Texas West Capital, and we're going to talk about some markets today. CPI numbers come out, what we were expecting. You know, I think the consensus was 8.5. We came out at 8.6, so highest rate since 1981 in 40 years, and that just has the hyperinflationistas just going crazy. And here's the thing, guys: when it comes to markets, the extremes are usually where price reverses, and things reverse. And so hyperinflation talk is at an extreme here. I mean, I can't swat enough of these hyperinflation bugs off my Twitter, to save my life there. And so, what are we going to do? People are going to believe what they're going to believe until they're shown different, and then they're not going to admit that they were wrong or that they didn't know what they were talking about. This is really rampant there on, just in social media in general. It's not just crypto Twitter, guys, or fin Twitter or anything like that. It's also, religion and politics and all that kind of fun stuff. Everybody wants to chime in with their opinions, thinking their opinions hold the same weight as another person's, and they really don't, guys. And I think that's really an important thing to understand about life. There's such this desire, it seems, with the generation coming up today, to be heard, to be valued, to be to make noise. And so, it leads to this whole idea that, well, I've talked about this before, you often get the reply, well, it's my opinion, and, it's okay to have it. Well, sure, it's okay to have it, but it doesn't mean it's any more right than, somebody else's, especially if you're uneducated in that particular subject matter. And so, we see a lot of this in all these really emotional driven subjects, like I said, religion, politics, government, finance. And, so the important thing for you guys to understand, hopefully, is that if you find yourself in that situation, that you back off. You don't do that, because there's a lot to be said for things, especially in economics, guys. There's different ways of looking at numbers and information. And some people are pushed by what, econometrics is basically created so that governments have, numbers that they can point to when they're trying to do, when they're trying to make policy. I'm not a big fan of econometrics. I don't believe in it a whole lot. I'm very much, my understanding of economics is much more Austrian based in that economics is that trade between people. You don't have to try and bring it down into some kind of mathematics. It's that point of trade, right? It's the humanities side of it. It's what are people feeling? What are they thinking? Rather than the actual numbers that come out there. So, that's how I have to look at it. And I'll tell you what, guys, it served me extremely well. A lot better than most of the econometrics out there that I've seen. So, we'll talk about that today here. We'll take a look at Bitcoin, maybe nearing an end here. And we'll talk about what we can look for if it doesn't. The DXY, again, popping up above 100 again, pulling right back. So we're kind of sitting right there below it. That $100 mark was what I talked about, oh gosh, just over a year ago when we bottomed out there at the first week of January of 2021. So we're kind of reaching that target here. Had a lot of pullback, had a lot of, argument about that. That lasted pretty much all through the year until like the last month or so. But, again, it's people. People are, and it's mostly arguments by people that have no real understanding of it. The other side that we're arguing against were those that think, again, they're just looking at this, romanticizing the demise of the dollar. I keep talking about this guy. This is a central theme that has shown up since, especially since the 70s, since Bretton Woods, and where the U.S. officially became the world reserve currency. Prior to that, from like the 50s to the 70s, it was the U.S. dollar and gold kind of side by side doing that reserve currency bid. But then Bretton Woods, of course, brought it up to the U.S. Dollar there. And so ever since then, there's this strong romanticizing of the death of the dollar. But there's nothing going on there right now. Now, locally, people think, okay, when I say locally, I mean in terms of time. right now, the big driver for people, they're scared about hyperinflation because the big argument is, 80 or 85% of the dollars in existence have been printed since 2010. So yeah, we're definitely getting hyperinflation, but yet they don't realize all that printing, all that time, we've actually, only until just recently with the supply chain bottlenecks, only until just then did inflation really even rise. The prior 10 years before that, during all that money that was printed, we actually had deflation a couple of times in there. But the Fed struggled to try and, because, they think they can control inflation, tried to get it up there to 2%. They couldn't do it. So, again, a lot going on here, guys. But I don't think people really want to learn or want to think. They just want to, kind of, regurgitate these sound bites. Because as we've discussed so many times before, people live on sound bites today. So hopefully if you're attending, you're open-minded enough, even if you think these things. I'm not trying to deride you for thinking that, but I do have, some thoughts here about, hey, listen, if you're not willing to open your mind and think beyond what the soundbite says, should you really be in the market? Because the soundbites are what dominate retail traders. And retail traders, as research shows, are significantly the losers in the market. Very few retail traders actually make it to consistently be profitable. And I really believe it has a lot to do with the things we talk about, which is, impatience, emotion-driven, whatnot. And then not changing the way they think when they come into the market. And then beyond that, again, or even along with that, it's taking these sound bites, verbatim and as God's word, basically. So, I try to dispel that while we're here every week. And I'm sure it falls on deaf ears most of the time. But for those few of y'all that actually listen and consider, I think it says a lot about who you are as a person and how ready you are for the world. Because the world is all about change. It's not about these constants, right? Other than markets and situations in what tend to reverse at extremes. So anyway, hey, listen, you can join us here at TexasWestCapital.com. Just click on this little green link right here at the top. It'll take you to our other site, HowToTradeToWin.com. And you can join us tiers 1, 2, or 3. Tier 3 is where it's at, guys. All the education we have putting on through there, including 3 live streams every week. So we'd love to have you there. And just, yeah, man, I say this of what we have, but really most of our membership has been with us for a few years. Many of them have been with us as long as I've been around. So I'm, 4.5 years now. And they stay for a reason. They still have to pay. They don't get it for free. They stay because I believe that they feel there's value in that. So when you're kind of looking at, where should you, if you want to spend your money to get some type of mentoring or education, where should you spend it? I think you look at the places where people stick around. And so that also makes it an amazing community, guys. Not everybody talks. It is what it is. I don't pressure anybody to talk out there. But we do have members that are constantly pushing out their ideas and discussing, and you can gain a whole lot from that. So as well as, everything that I do there. So I think our members are what make it so great. But anyway, we'd love to have you there, right? So who's here already, guys? We've got, my gosh, I'm sorry, my eyes are so off today. Let me see if I can read here. You know what? We're going to try to do this. We're going to try to throw some glasses here, guys. Oh, man. All right, let's see here. Not helping a whole lot. But it looks like the last name there is Mangal. Checking in from Vancouver. I hope I didn't butcher your name. Glad to have you checking in. Oscar, what's up, man? He says, so are we stepping into the end of times? I think I will give up investing for 10 plus years and just open a food truck with bug burgers. Bug burgers, huh? Cockroach Agnes for $1. Oh, man, that might not be such a bad idea. I don't know. Atama, hello, good to see you. Claudio's here. Nevlusian checking in. Who else is here? Camilla K checking in from Smyrna, Georgia. Glad to have you along. HJ is here. TV Canal. Who else is here? Is that Dancer Eddie? Man, every time I see the name Eddie, I think of, Cousin Eddie from one of my favorite movies or series there, which is, National Lampoons. I admit it. I love this series. of movies. Crypto Mowgli, what's up? Data's here. Mike Slane, what's going on? Let's see here. Is that, it looks like Lozano's the last name. Good to see you checking in. Keith is here as well. Jared the Great, he says, it's amazing stocks are so close to the all-time high with all that's going on in the world. Sign of strength or massive fake out? I think, man, you know what? As I continue to look at it, I think we're about to get one of them big, third waves down kind of thing. Especially after, that CPI print today, which the CPI print just gives the Fed more, more fuel to kind of do that 50 basis point hike next. I think it's a real possibility. I can't guarantee it's going to happen, but I definitely think it's a real possibility. So yeah, let's keep watching on that. Let's see here. Michael Williams, what's up? Bamboo, good to see you here, buddy. Let's see here. Brian Riley, hello, sir. Bamboo says, what do you think about? Can you say ECB mentioned yesterday to prepare for a blowout in bond yields? Man, yeah, I think bonds are just kind of sucking wind. I mean, and that's what we expected, right? Who's gonna, we've talked recently about the inversion of the yield curve, right? And how we had the 2 over the 10, and how I talked a few months back, like Q4 of last year, when we had the what was it? I think it was the, oh man, what was it? Was it the 2 over the 30, the 10 over 30, something like that? And I mentioned that, this was just the start, and to look at Q1 where we'd probably be getting the 2 over the 10. And what we're really kind of looking for is probably a 3 over the 10. And then we discussed, how that usually over the last 50 years has led to a recession within an average of 18 months after it. But, again, that's an average over all those times it's happened. So, it could happen in a month, But, yeah, I mean, bonds, it is what it is, man. I mean, interest rates are rising. The ECB, again, they're still well behind the U.S. Fed in terms of, hawkish behavior. And as long as that continues to be the case, there's no real case for the euro to strengthen, to appreciate significantly against the dollar. And so what that means is, DXY probably continuing to head higher there, which then self-feeds on itself and makes people more, desiring the dollar more. Because again, we talk about the big thing, which is U.S. debt, right? So if you hold U.S. debt, it has to be paid in U.S. dollars. And so the higher the value of the dollar goes, the more expensive it becomes for you to service the debt. So if you're a big international company, or if you're a country, that's going to affect you significantly. There's things that you cannot do any longer because you're spending more of what you have on servicing your U.S. debt that you have. And so that's become a big thing over the last couple of years, since we had that 2020 drop, where the Fed stepped in and started backstopping everything and, bonds and all that. And the Fed's not doing that anymore, which is interesting. It comes at a time here, the Fed's talk about tightening its books there, right? So QT instead of QE now, right? Quantitative tightening, which means they're going to sell off treasuries and mortgage-backed securities, your MBSs, right? So that comes at an interesting time when is the world really looking to buy treasuries right now? I'm not sure, at least countries, I'm not sure they really are. I'm not sure that, that the big purchasers are really still out there at the moment. When you look at, you look at China kind of cutting back its holdings. You're looking at Japan and its inflation and what it's doing there. And then, of course, you're kind of looking at, when you talk about countries, I'm not going to go into this right here, but, when you're looking at bond rates with countries and, you look at the currency markets to kind of to hedge your risk when you're working with that. And I don't know that I see the Fed kind of releasing, treasuries at a time where there's the kind of demand there was previously. So, I mean, it should all be interesting. We'll see it. Like I said, CPI came in. Let me see here, guys. CPI came in at 8.6, I believe. Oh, let me kind of catch up. I got it written down over here. Oh, let's see. Oh, it came in at 8.5 year over year. It was expected to be 8.4. So a little bit higher here. This is something I warned Discord about yesterday. I said that we were likely to, at least get the 8.4, but probably 8.5. Very outside chance we might get 8.6, but looking at that 8.5, that's what we got. Core CPI though was expected to be 0.5% month over month, and it was only 0.3%, which means core CPI now also missed on the year over year. Core inflation was expected to be 6.6. It was only 6.5. So again, we're showing a slowing down. Now, core inflation, of course, is that CPI minus your food and energy. And why would you take out food and energy? Well, you take that out because it's very volatile. Again, the biggest driver of inflation, has been the rise in oil, right? And then, of course, you've also got, used car sales and, rents and mortgage and stuff like that. So that's the big overall CPI driver. And so that helped it, again, go 0.1% over what was expected. But your core CPI dropped. And so, that core CPI dropping shows a slowdown. Now, something I talked about previously was the fact that oil is probably topped out. So oil is this big driver of CPI, right? Because it's so expensive, right? Not only is it, remember, oil is not just used for transportation, guys, for fuel, for gas, right? It's also used in most of the products we have. It's used in plastics and other stuff, right? So higher oil prices mean higher prices all around. So if the price of oil is dropping, well, then gas starts dropping as well. And so we're seeing gas kind of dropping here recently as well. So oil topped out probably. I've been showing you last couple of weeks about housing, which I'd been talking about was likely topping out Q1 here, Q2. And so we're seeing that now. Showings have dropped off. Houses that are on the market for a week or more are much more difficult to sell. There isn't the kind of overbidding that we've been seeing, which means sellers have to be a lot more careful now. So again, another great addition to the CPI there is dropping as well. And then, of course, used car sales are dropping. We've seen coming up another big push in there. So, I think, as I mentioned, I believe that CPI is probably topped out for the year. Probably topped out, period. Now, I think we could still see core inflation up there around 6% through the end of Q3 into Q4. But I think by the time we're hitting Q4 of this year, Q1 of next year, I think core inflation really starts to show some slowdown, or not some slowdown, but some drop. So it's going to take a little bit for the rise in prices to kind of work itself through the system and going on there. My favorite argument right now for oil was that oil shot up, continued to rise because of the war in Ukraine, which I think is kind of funny because, again, we were already looking at it nearing a top out point there about where it topped out. So, again, if you're not a real believer in Elliott wave, it's just this understanding of how people tend to act and react, and it's a measure of the social mood. So social mood is what it is, and people buy or sell accordingly, which means your charts then are a product of that social mood, not the other way around. Most people that look at the markets today, they tend to look at the charts and go, okay, well, this is what's happening, so it's going to cause people to do something else. But again, I really believe it's the other way around, and that belief has worked extremely well for me. We've talked often about how, people tend to associate news events with price action, but only at certain times, right? So price action and news events happen all the time, but only on certain times do they actually connect them and say, oh, look, that's what it's because of, kind of the UK oil thing. But the reality of it is, guys, if that was the case, then there's so many other times which you should see the same thing happening, but you don't. You see the opposite. And so when it comes to markets, if something doesn't happen consistently, then you can't use it as a metric for what may happen later. Because otherwise it's just a toss of the coin, right? You're looking, as traders and investors, you're looking for consistent things, right? If somebody says because A, B happens, then it needs to be because A, B happens. It can't be, well, because A, B this time, but next time, no. And the next time after that, no. But then the time after that, yes. But that's how people tend to believe and trade, and they don't realize it, I don't think. So yeah, okay? So those are kind of things, again, that we often discuss here, and usually makes people hate me. But I'm not here, guys, to blow smoke up your rear ends. That's the whole thing. I'm here to kind of give you an honest look at what's going on and things that are going on and what may be expected. And this is even higher ups. I see Hank's here. What's up, Hank? Checking in from Bali. I think it's his favorite place. Second, I think, is Thailand, right? But, a year ago when we were talking about the rise in the dollar, Hank was working at his bank and he said that their bank's economist was saying, definitely it was going to drop below where it'd been in January there, and it wasn't ever going to reach where we're reaching here. But they were wrong. And so, again, a lot of times, the problem with things like economics or whatever is that people are going to be often driven by their personal biases, right? And so, and it's a difficult thing. We're humans, guys. It happens. It's not that people are terrible traders because they're driven by bias. It's that they don't recognize that they're driven by bias and do the things that they need to do to try to combat that. And it's nothing that happens overnight, guys. And it's nothing that you just do it once and you're forever good. As a trader, you've got to constantly work on that. I always talk about emotion being this big driver in what we do in the markets. But that emotion is not that simple to get rid of. It's simple to say. It's a lot more difficult to do because we're social creatures. We are emotional. But even me today, again, been doing this a very long time. And so I still have to make sure that I keep my emotion in check as well. Okay? And it doesn't always work. It still does. As much experience as I have, it still doesn't always work. But I only tell you that so that you don't get to thinking, oh, you'll never be able to be a good trader or something. You can. But that's why risk management is so important, okay? Risk management will save your butt every day. Let me see here. Excuse me. HJ says, I just back tested this weekend one of the systems that I taught on the Wednesday. He's talking about the Tier 3 Wednesday live streams that we do. Those are usually rules-based systems that I teach, where even if you've never traded before in your life, you just follow the rules, and you follow the system. But he said, let's see here, last 40 days, it has an 84% win rate if you always take the first entry of the day. Hell of a system there. Hey, man, glad to hear that. Yeah, again, guys, I'm fortunate that I've been doing this as long as I have, so I have a lot of knowledge to share. And as people, not everything means the same thing. Not everything is easily seen the same way by different people. So stop listening to anybody out there telling you that their system is the only way to do it. It's the best thing out there, because I'll tell you what, the best system out there is the one that you understand and you follow the rules religiously and you work. Everything, it all works, guys. It all works. But like any other skill, it's something that you have to do, consistently. You have to practice consistently and properly over time. You want to learn to play the piano, you're not going to learn it tomorrow, right? Ride a bicycle. You're not going to be riding a bicycle, 5 minutes after you start, right? You're going to fall down still. Swimming. You're not going to be, I can't even think of his name anymore. That U.S. swimmer. But anyway, you're not going to be this great Olympic swimmer. You may never be that, right? But you're not even going to be a consistently good swimmer without practicing for a while first. And so trading, guys, please understand, trading is no different. Stop listening to the yahoos out there who tell you Elliott Wave doesn't work, or Wyckoff doesn't work, or supply and demand structures don't work, or, volume price action analysis doesn't work. It all works. You just got to learn how to do it properly and then practice properly. Okay? Let me see here. Bitcoin Anarchist checking in from Australia as usual. Good to see you checking in, man. Always so early morning for you. Is that Tabor Football coming in from Kansas City? Good to have you here, man. Let me see. Brian, of course, coming in from Denver. Glitch Trader, hey, thank you for checking in, man. Jeff Bear says, I agree that this could be the peak in the year-over-year CPI, considering the base effect measurement mechanics. March 2021, 2.65% jump to April 2021, 4.15%. So we will measure next month, year-over-year, from way higher prices. Yeah. We're looking at, like I said, I think it's probably the top. If not, it's going to be here pretty quick. I don't believe we've really got any further to, any measurable furtherness to really go with that. So, yeah. 83 Mad, what's up, man? Tell you Ryder here says oil is gas, oil is fertilizer, food, clothing, medicine, on and on. Exactly. I don't think enough people really understand that. I'm fortunate when it comes to oil that I come from West Texas. So, even if you don't work in oil, oil is really a big part of who you are. So we have a lot of understanding just from being in that area and it being such a big part of the economy as far as what's going on. We tend to watch things like Baker Hughes rig counts and stuff like that to kind of see how the oil is going. But it's not just there in West Texas. It's also down here in South Texas where I am now in San Antonio. Large, oil down here as well. Fracking, horizontal drilling, big things to pull out a lot of oil. That's how U.S. became so dominant with their oil production, up there through the end of the 20 teens. And so, that combined with the easy money. It's more expensive to drill oil, to take oil sideways and to frack and whatever, than it is to just do normal vertical drilling. Horizontal drilling is a lot more expensive. So when oil prices are really high, there's going to be a lot more exploration, a lot more wildcatting going on out there because it becomes affordable. When oil is down at $50 or $60 a barrel, it's not so affordable to drill sideways horizontally. So as long as oil prices are higher, you're going to see a significant output from the U.S. Because of that horizontal drilling. So yeah. Phelps was the swimmer, yes. Brian says, I'm not sure I understand what you mean by news events. Example, if Coinbase had a major hack, would be a news event and price of crypto may drop. If Apple bought several billion in Bitcoin, could go up. Yeah, that's, those are news events, sure. But they're always knee-jerk reactions. So movement today in the markets was a knee-jerk reaction to the CPI print. The overall trend remains in effect. Okay, so these news events don't actually change the direction of the trend. Now, every once in a while, somebody will a news event will become big with price action, and it'll be at a point where price is reversing. But, again, if you're following Elliott Wave, it'll often be a target that was already set. So it's not doing anything out of the ordinary, anything you wouldn't expect if you're following through correctly with Elliott Wave. So, yeah, that's what I mean about that. Esteban, what's up, man? James Davis checking in from Carson City, Nevada. Have not been there, man. How likely is a liquidity crisis as rates rise? Man, I love hearing that. Yeah. Well, I love hearing it not because I want a liquidity crisis, but just because I love that people are actually considering that. Most of the people talking about hyperinflation, again, it's all about their thoughts are two-sided. One is all the dollars that have been printed in the last 12 years. The other side of it is prices rising at their fastest rate in 40 years. But they don't think beyond that. They don't look at demand. So as I've shown you guys through various charts over the last few months, dollar demand continues to rise. You're not going to have hyperinflation if you're printing a whole bunch of dollars and the demand continues to rise with it. Hyperinflation, you need to see a significant production of dollars versus a significant drop in demand. And that's only the beginning of it. Again, it's a lot more to it than simply just printing dollars. Inflation as it sits now is a combination of supply chain issues and then some extra money coming in. But here's the thing. No more extra money. Right? We're not getting all these payments coming from the government anymore. There's still the student loan moratorium that's going on right now, which has been extended from May now until August, I believe. So that big thing is still not coming down for people. So that big expense that they normally pay. The two largest expenses for most U.S. citizens is mortgage payment or rent and student loans. And so we had the mortgage moratorium that ended in most places. I think it's still around in a few very highly. They kept it around in a few places that were getting hit by COVID pretty bad. But for all intents and purposes, it's basically gone now. So, people have returned to having to pay that. We're seeing defaults starting to rise, which is what I discussed would happen when that happened. We're going to see the same thing with student loans. When they finally say, okay, enough is enough. We can't just keep off putting it forever. We got to go and put it in. They're going to see a lot of defaults on that as well. And again, so when we talk about deflationary spirals, this is where you go with it, right? So if the government's no longer backstopping your businesses, right? They're no longer buying bonds and corporate debt and all this stuff. And so the corporations have been gouging themselves, just drowning in picking up new debt over the last 2 years. Now, it's the piper's come, right? It's time to pay the piper, right? So they have to now pay it back. So now all of a sudden, more of their income that they have goes toward paying up, more of the revenue goes toward paying off their debt that they've, especially recently, really kind of collected. That's not a great thing, right? Because now they can't use that money to produce more. They can't use that money to streamline their production, make it cheaper for them to produce things. And on top of that, so what does that mean? That means less revenue coming in. That means they start laying off people. People that are laid off no longer have money to buy things. They lose their houses, right? They go into default on their mortgages and their student loans and whatnot, right? Again, not spending more money. So even less revenue coming to the company, even more companies going in. Remember, the big theme over the last 2 years has been zombie companies, right? So these companies that should be out of business, but they're being held up by government buying their bonds, right? And then people buying into them because they think the government's going to backstop them forever. Think things like Hertz and whatnot, right? And so, again, that time comes. And so what happens is you get this spiraling effect, and people start saving the few dollars they have. Remember, if you're saving dollars, if you put dollars under your mattress or in the bank and you're not spending them, that's disinflationary at the least, potentially deflationary depending on how many people do it, right? Because that is money that, it doesn't matter how much money's printed, if that money is not actively circulating throughout the economy, it has no real effect on prices. Think about what I just said. You can print all the dollars in the world, but if they just sit there, it has no effect on price. It has no, a negative effect on price, causing prices to rise. Negative effect for us that are buying. And so, that's just one of the things that you have to watch. If people are paying back debt, remember, we are in a credit cycle. The world basically is in this large credit cycle, right? We're all based, debt-based economy, which means we need credit to continue to expand for the economies to grow. And so if you have people that are not taking out as many loans, so a decrease in loan demand, and you're also having people that are paying off loans, so you're destroying dollars, right? When you pay off a loan, you're destroying dollars. Those dollars are no longer in circulation. They went back to pay off whatever it is that you had there, right? And so those two ways, again, are other ways in which disinflation comes in at the least, potentially leading to deflation. So you got all this stuff kind of happening, starting to kind of finagle and bubble and boil and happen. And, I think at the least you get stagflation, but I don't think so. I think we still get deflation first, and then we get stagflation. And that stagflation is what keeps the bear market going for quite a while. Because, again, remember, I think we're probably more likely heading into a depression than a recession right now. And so, again, that deflation gets us down. That stagflation keeps us there. I still think that's what's going to happen most likely. But we'll see. We'll see. Feel free to come back and talk about it when something different happens. But I do think that's kind of where we're headed with things as they are. Okay? Let me see here. So again, there is a potential crisis with dollars out there, guys. So much so that the Fed continues to discuss potentially getting ready to open swap lines if needed. Swap lines are just a way for countries and whatnot to get their hands on USD, on dollars, when they otherwise would maybe not be able to, because there's such a so less dollars out there for that, making a way for them to be able to get. And so this has been that other thing that we've been talking about for the last probably 6 months or so, right? And so, a very real thing going on. Lack of dollars is going to also be a self-driver for dollar demand. If you have to pay your debt in dollars, which you have to if it's U.S. debt, if you're going to pay taxes, U.S. taxes, you got to pay it in U.S. dollars. Legally, that's the only way it does. You can't pay with Bitcoin, not your U.S. federal taxes. And so people are going to have to pay more money to swap out whatever their currency happens to be to gain those U.S. dollars. So very real thing working its way in there. do your research on what the euro dollar market is and how big that is. I mean, the best the Fed can usually do is just kind of have an idea of what's going on with money that is in the U.S., right? That is within its borders. There is a lot less understanding of just how many dollars are out there in foreign banks and otherwise. Those are your euro dollars. And so, yeah, strong demand. It's not just demand from the U.S., it's demand from the world, because the U.S. dollar is it's that grease for the global economy, right? It makes it easy to trade from one currency to another, or to use one currency, if you're buying something in another currency. That dollar is that middle ground, that easy way through. So, yeah, again, all this stuff that people are all yabbering about hyperinflation don't actually ever consider there, okay? Moogs, what's up, man? Yeah, you can trade the dollar on the ICE exchange. You can trade dollar futures. Yeah. So that would be the place that you could do it, the ICE exchange. Let me see here. What happens if or when the House and Senate change control and there's gridlock? Does inflation cool off? Yeah, I don't think, again, all that stuff I think is, I don't really give a lot of deference to, fundamental stuff like that, because that tends to follow. It's all reactionary. The Fed, as I've told you guys time and time again, is reactionary, right? You're seeing it right now. They waited too long. Inflation's really high, right? Prices are really high. And so now they're trying to get in, and they're trying to get in really strong, right? But it's all already happening. Everybody, them, the Fed, the Senate, whatever, it's all reactionary, which means that it's good for at best, a knee-jerk reaction, but it doesn't actually change the trend of what's happening. The trend of what's happening in whatever market you're looking at is the product of that social mood. How are people feeling? They show you how they're feeling by how they're buying and selling in the market. So yeah, that's what we're kind of looking there. Kimozabi, what's up? He says the 10-year Treasury note yield did hit the descending trend line yesterday that has been respecting since 81. Yeah, we talked about that, right? The yield corrected down since it did hit that line. Yeah, again, we'll continue to see it, what goes on here as it works out. I think we've had the highest rise in interest rates since oh gosh, let me see if I've got those notes here. This rise that we've seen here in interest rates, sorry guys, give me just 1 second. See if I can find it again. See if I've got it sitting here real quick. I say interest rates. I'm talking about in terms of mortgages, because that's such a big part of CPI and whatnot, right? And how the economy's doing. But I think we've had the largest annual change since like right around 1980 or so, I think. And so interestingly, if you'll remember, 1980 was when Volcker raised interest rates really, really high to try and combat what was going on with the 70s, right? With inflation in the 70s and whatnot. And so 80 was kind of where it started finally taking off, right? And so that rally up there from, gosh, I don't know, probably about 76 or so, ended up running up into 1980. And so we're seeing that largest kind of rise with that since that time. So, but again, it falls right in line with inflation being at that 1981 kind of level, right? But, a lot of people that talk about inflation, they're like, all they compare is 1970, 80 there to now. But, 40 years prior to that in the 1940s, they had the same kind of, what happened in the 40s and the way it was different than what happened in the 70s and the way it was, which is different than what happened today and the way it is. So, people are stuck not thinking beyond 1970s and what Volcker did there. And then they're trying to figure out, well, how does that work with everything that's going on here? And again, I think it's a big part of they don't understand that the Fed is reactionary. Okay? You really have to kind of internalize that and understand that So that way you can look beyond what the Fed's doing, and you start getting an idea of what the Fed may do. If you guys have been following me, you know I'm calling this pretty close here for the last 4 years, right? You know, interest rate rises and hikes in spite of what the Fed says at the time, ends up doing what I'm talking about it's going to do. And this year, they're talking about a lot greater rise in rates than what I was talking about. Remember, last year when they said, hey, we probably don't see we're going to raise rates until 2023 minimum. We're going to continue QE into 2022. And you remember at the time I said, I think, QE is going to be ended there. They're going to start ending there in the Q4 of last year. And I said, we're probably going to have 4 interest rate hikes this year. And so what happened, right? So again, Q4, QE, they begin to end QE, right? Now they're talking about, again, QT now and all these different rate hikes. Now, are they going to get all these rate hikes that they say? I don't know that they will. But nonetheless, it's running in with what was expected. And that's because I don't see the Fed as leading. I see them as fully reactionary. And as reactionary, they're doing as you would expect. So, again, guys, the way that I look at the charts is based on social mood and what's going on there, showing itself in the charts, not the other way around. That's what I'm trying to get at there. Jeff Bear says we had a parabolic run on the interest rate, so a correction is due in his opinion. With CPI peaking, that would make sense. Yeah, he had a parabolic run. Yeah, exactly. Remember, when it comes to markets and things, guys, it is the extremes at which things usually change. So when everybody's usually saying A, it's often B instead. Okay? So don't get caught up in that. All right, let me see here. Have I talked about silver yet, Kevin? No, sir. I'm gonna get over there in a minute here. ARM, what's up, buddy? So let's go ahead and talk here. So Bitcoin here. I'd given you some last time. I'd given you some ideas about where we could potentially be looking at, and I said, if those broke down, then we were probably looking at the daily S1 pivot potentially, and that's pretty much where we're at. I have updated the count to say that A completed up here, so. Coming off the lows back over here in January, we've got a W and then an X as a triangle and then A, B, and then we'll be working on C of Y of D of the triangle. And so if this is correct, then based on the height of wave 4 here, we should be looking for a wave 5 target around 38,312. And so that'll dip us just below the daily S1 pivot and just below the S2 pivot on the 1 hour. And then if we zoom in here to the 15-minute, you can see it's right there at the current 15-minute S1 pivot. So if this is correct, we had this 50% rally up here in 3 waves. Let's see here. If this is 1 here and that's 2, looks like we might be a little bit higher here. It looks like, so based on the height of wave 4, we had this target down here, but based on wave 1 and 2 here, it looks like we may only get around 38,667 or so. We'll say 38,668 since it's 59 cents. So that would be the first place I'd look for it. And that makes sense. This is what I was telling, I've been telling Discord a lot, our members there, is that it's likely just to be like a dip below and then a strong rally back up because it's been so much pushed down, right? So your 15 minutes still has to drop back down into oversold here on the RSI. Well, it doesn't have to, but it's likely going to. Stochastic RSI still got to come down. Your 1 hour is coming down now, so we want to see this come down. Now, if this drops down here, depending on how quickly it does that, we could see bullish divergence print over here on that rally back up. It's possible, so I'm going to be watching to see if we get that. Now, the 4 hour is down here as well. And so, again, the same idea would be that potential bullish divergence here that prints on the RSI and as Stochastic RSI pulls down into oversold. So, again, that's what I'm going to be looking for. As far as the daily goes, I talked about the idea that we may need to see the daily at least dip into oversold, even if it doesn't stay there. It does not need to get down into it. There's been other times here in this range where we've had it dip down here to hit the lows, right? Here was your swing low. Look at this. We had bullish divergence here, right? And it didn't dip into oversold. Again, you had this swing low here, right? Did not dip into oversold and rallied back up really well. So don't think that it has to dip into oversold. It has already dipped down here. Okay? So, it might dip into it, but it doesn't have to close down and oversold. So don't think it does. We're pretty close to that area where it might normally rise up and rally out of that. Now, here's the thing, guys. Let me kind of pull up my other chart here. If there we go. So if this does happen to break, see this count, this local county, this WXY with an AB here, it holds as long as price stays above this swing low over here at that 37. Oh, what is this? 37,560 and 40 cents here on Coinbase. As long as it stays above that, the count stays, right? Now, here's the thing. If it dips below that, that does not necessarily mean that we have to go down. Instead, what that could mean is that instead of a W, X, and then a Y here, we actually have an A, B, C to give you a W. This is X, and then we'd have Y up. So an A, B, C to get Y up, okay? So just because it breaks down below, that does not mean it necessarily has to continue down lower here. Now, there's still the possibility it could dip down below this, and if it does, in terms of the structure, I believe that just gives us a spring. And it'll be short-lived on the drop down, it'll rally back up, and then we'll just really get into gear rallying up at that point. In that case, as I've said multiple times, it's likely that we would be looking at potentially this S1 pivot area here on the weekly. So again, that would be the target if that were to happen right there around 26,250, 26,300 maybe. Right around that area. But in terms of this overall structure, it would just be a spring, rally back up within that week. So the weekly would be just a wick down below it and back up. And close it back above it, and then we'd be, at that point, we'd say, okay, we're probably headed up. And so, again, we'll see if that happens. Remember, on the monthly here, we're still looking at the idea that we've got this going right here, which is this hidden bullish divergence. And then locally here, this is the monthly, so we've still got over half a month left for April, right? But right now, we're kind of trying to dip down a little bit there, and we've got higher lows here. So again, more hidden bullish divergence if it does. But once again, it is just the monthly, so you've got to wait until the monthly ends to kind of see what happened. It's way too early, not even halfway through the month yet, to say, oh, something's definitely going to happen here. These wicks here show you all the demand. There is demand in all these wicks here. So that's a lot of effort that has to be worked through. I'm not saying it can't be done, but you have to recognize that there's a lot of work that has to be done to get through all that demand to push it lower. So, again, we have our options that we're watching as it develops. And right now that option says, okay, well, it looks like we're nearing completion here of, this one right here. Get back in that 1 hour there. Of wave 5 here. Now, the only thing that changes anything is if we happen to break out above wave 4, that might signal, hey, that the bottom may be in here. But as I told Discord, the size of wave 2 here, there really isn't a comparable wave 4 until you get to this. So for right now, unless it breaks out and heads higher and kind of gets up into wave 1 there, the idea that this is wave 4 here makes the most sense. Now, what does that mean for you? Well, as a trader, that means what you're looking for in terms of Elliott wave is a breakout above this swing high up here, 443 and 32 cents. If you break out above that, that's your first real clue that the bottom's in for this decline. Break out above wave X up here at 47,469 and 40 cents is going to add confidence to that idea. It's going to suggest, yeah, all but guarantee that that decline is done and prices rallied up. I say all but guaranteed because, guys, listen, there are no guarantees in trading. Okay? That's why risk management is so important. But, again, the idea of trading is that you look for validation levels that you break through, which adds confidence to the idea that you think may be going on. So that's all we're kind of looking for here. If we get the breakdown below wave 3, well, then you've got your initial target of 38,668, secondary target down there 38,312. If you get down below wave 3 and you break out above wave 4, that's going to be the very first hint. So the very small clue that maybe wave B may be complete. But you need to see that follow through above wave 4. Why do I say a hint? Because it's always possible that wave 4 could be building some running triangle, so it dips down below wave 3 to finish the triangle. It's possible it could be printing a flat. 3 waves up, 3 waves down that break down right below wave 3, and then 5 waves back up toward the swing high or a little bit higher, and then it goes down. So it's not a guarantee that just because it breaks down below wave 3 and then back up below wave or above wave 4 that it's definitely going up. But if it does, especially if you can count 5 waves coming down here in a smaller time frame below wave 3, and then it breaks up above wave 4, again, that will hint that wave B is probably done, but you really want to see it get above that wave circle 4 there. If you're still not into that, the other thing that you would do here, guys, just zoom out to the daily. Wave 4 is right here, right? So what you're looking for is a break, especially an impulsive breakout, which means larger candle spread, nice spike of volume above the daily pivot. If you can do that, that's going to signal the bottom's probably in. It's going to be even more strongly suggesting that if you do break out impulsively above it, come back, retest it as support, and then break out above that swing high. So let's say you break out here, you hit this area up here around 45.5, this resistance, and then it pulls back to the pivot area, and then it rallies up above that. So boom, boom, and then rallies up above that high that you just printed. That's gonna say it's all but guaranteed that the bottom is likely in there at that point. In terms of what we're looking here, that means we'll have wave D, which will probably, since we've had such a deep pullback right here, it'll probably be closer to the lower to mid 50s rather than the upper 50s to 60. And so you're looking for 3 waves up into that, and then 3 waves back down for E, and then the triangle's done, and then you're looking at a breakout and head up. That's how I am watching this develop right now as it does, guys, okay? So those are the levels I'm watching. That's why I'm watching it. That's how I'm watching it. I did talk about the CPI report, Andrew. Yes, sir. SHIB USDT pumping hard. Doesn't that mean the bull market is back in full force? That means people are into SHIB for some reason. I don't know if there was any news that happened recently, but, again, didn't I talk about that last Friday? SHIB and Doge? Oh, no, I talked about that on Scott's podcast. Not last Friday, the Friday before, right? Yeah, because last week I think he was over in Bitcoin at the conference. So, yeah, I did talk about that there. So, yeah. SHIB got listed on Robinhood today. That's why? Okay, yeah. But I think I was already looking at the possibility that the bottom was in. You guys can check out Scott's podcast that I was on there 2 Fridays ago. So that would be what day? I'll help you out here. Looks like that was the 1st of April, April Fool's Day. And you can look back on that, and I did discuss SHIB and Doge. And I don't know if I'm thinking about it. I think I did say that the bottoms were probably in or pretty close to it. So again, if I did say that, then what's happening now is just, it's not that the Robinhood thing caused it to go up, but it's just that it was expected to happen anyway, right? The Robinhood did, give them reason to buy in, I guess you could say, but it was already expected to be there. So the news and event didn't really change what was already happening. That's what I'm trying to talk to you about earlier in the show here. So yeah, Solana and Poly as well. What's up, Mark? Good to see you. Good to know. Dex, thank you for checking in, man. So there's what we got right here. Again, guys, still no change. And I know that's frustrating for some people because they want me to change my opinion when their emotions change, right? But I don't do that. I've got firm basis for what I'm looking at and why and where my validation levels are and what they could mean, what price action could mean. And that's how I trade, and that's how you should trade as well. So hopefully, especially if you're new, you're not too frustrated by me still looking at the possibility that we're just bottoming out and ready to head up. I have, a lot of reason to think that as I've been discussing. So we'll see. But again, even if it does, we've got two other possibilities, right? Instead of a WXY, we've got a WX and then Y. Or I guess instead of an ABC, we've got a WXY. Or if it does, really kind of break on down, then we're just looking at a spring on the range. None of that says 19,000. None of that says, not that I can't guarantee that it wouldn't do that, but there's no reason for me to think right now that 19,000 is even something to worry about. But even if it does have that dip, it should just be a dip. In terms of the weekly, it should be a wick below the range support and rally back up. But even when I say that, guys, I still can't guarantee it. This is what you need to understand. Nobody out there can guarantee what's going to happen with price action. You just trade accordingly and use your proper risk management. Okay? So that's what I'm thinking there. Let me get over here real quick, guys. I spent a lot of time talking about some other stuff. Dollar, getting this rally back up here. See the knee-jerk reaction on the CPI report? And then boom, rallying back up. Still looking minimum wave 5 target up here at 100.5. Secondary target at 101, 188. And my God, if we keep going up, guys, we're probably, you can always look at the bottom of the supply structure around 102.2, but most often it tries to reach that EQ there at around, in this case, it'd be right around 103. And my thought is, I don't believe that's the end-all, be-all. I believe we'll just have a pullback into, mid-90s or something, maybe lower 90s, and then we'll have a continue to rally higher. If we break out above this swing high here, any bearish thoughts you may still harbor for the dollar should just be out of your mind if we break out above 102.992. Yeah. At that point, that's, as much confirmation you can get for the count that I'm looking at right here. Coming off this here. All right. So, again, I see this as a 1 and then a flat correction, expanded flat here. So A, B, and then C down for 2. And then we're looking at this move back on up. So, locally, we have these kind of 3 targets here that we're looking at as it continues to rally into that. I guess I need the 4 hour there, right? There we go. So we'll see. We're looking for this breakout right here. We had a rejection. And we're trying to break out now. So we'll see if we can get that. Let me see here. Let's see. You were asking about silver, right? Let's look at silver here. Okay, so what I told with the update this morning with Discord was silver had not broken out above here yet, but if I said if it did, wave 2 is still in progress. We do have some bullish or bearish divergence showing up here. Let me see here. We did break out. This is the daily pivot. I believe I've got it set right here. Yeah, right about that area. I'm a little bit off on that. There we go. Right around that daily pivot there. The daily still has room to go up higher here, so it is possible. I've got this count here as 1 and then 2 up here, and then looking at maybe a 1 and a 2 here. But it's very possible this could be a large flat correction here. So ABC up for 2, potentially ABC down, well, for A, right? ABC down for B, and then 1, 2, 3, 4, 5 working out here. The target should be this this daily supply structure here, up here in what's left of this wick. So continuing to to go up there. I think that's probably where we'll be headed. But that again would make the count a little bit different than what we have here. So instead of 1, 2, if we're breaking out above that, it'll be 1, 2, or A, B, and then C heading up. But if we stay below wave 2 here, again, this count still holds as a flat correction right here and drop back down. I don't think there's any reason to believe that silver is heading up to new all-time highs right now. That could change. The first real big clue on that might be a breakout above this swing high up here, 27.495. But as long as that holds, there's no reason to even think of that. And so the same thing kind of goes with gold here, right? So gold, I've already got kind of that same count that I was discussing there with the 1 down here and then A, B, and C rallying up. We've just hit the 50% retracement area, just above that daily pivot. If it continues going higher there, we might see it running up here toward the 61.8. And then, of course, we look at the 70.5 and then the 78.6. But a breakdown here below this 1 hour and 4 hour pivot right here at around 1938, 1939 kind of area, that would be the first clue that wave 2 would be complete. Dropping below 1916.20 here says, okay, we're headed lower now. So again, kind of what we're still looking at there in terms of where gold is likely headed. But again, you break out through the top here, the alternate count comes in, which says this is 3, this is 4, and then we've got a little bit higher up for 5, and then we have that big move down. So, it just depends on what goes on right here. Can we get this breakdown below wave B here and then a follow through below wave 1 to really kind of cement in this idea that we might be done here? If we zoom out a bit more, remember this swing high up here, this 20.89 and 70 cents was actually this swing high back over here on the 10th of August. Quite possible that we have a double top here. And if we do a breakdown below wave 1 of what I've got as wave 1 here around 1676 is going to give us a pattern target down here at around 1340 or so. Pattern targets are often third waves. If this was to be an ABC down, that might be what we'd be looking at. But again, for now, until something really significant comes up otherwise, I think we head below 1,000 for gold still. So we'll see how it plays out. But nothing's changed. If you guys have been following me for a while, nothing's changed. It's still the same thoughts because we haven't had anything change on the macro level as far as the charts go. So there's no reason to change. We don't get emotional and change what we're thinking about just because, the day's events, right? Or the week's events, right? So, yeah. Let me see here. Let's see. And so oil. Let's talk about oil. Remember, oil's a big driver of CPI, right? That's why we keep it out of core CPI because it can be so volatile and it has such a huge impact on prices of everything, right? And so right here, again, still looking at that top being up over here in March. I've actually got a March 9th. We've got different channels in here, guys. For those of you that are not part of Discord, we actually have different channels, discussion channels for the different things that I update daily or intraday. And so we actually have let me see here. Just to show that I don't change my bias. Where is that oil channel? Oh my gosh. Oil and gas general discussion here. And so back on let's see here. So back on the 9th of last month, I had a member ask me about, what was going on with OPEC and OPEC Plus, talking about some discussions they were having at the time and what would I expect coming on through there. And, and where that leads me to the count, right? So this is the 9th, which was back over in this area, right? And so what I told him is, I said, no, I think we are done or nearly so. As I wrote in this morning's update, I haven't had a chance to see where oil is at right now, but I did notice earlier today that it was dropping pretty impulsively. So coming through this drop here. And I said, so if that drop continued, then I believe it's likely done for now and that we will see it head lower. I don't put a lot of interest in what OPEC says or doesn't say. We were already looking at price being done or nearly so before they even said what he was talking about. So as always, social mood dictates the charts, which observers try to associate with current actions after the fact. So, it still continues to be my same position, even back here. I figured this was the top here, answered a question there on the 9th of March, and we have continued lower. And so now we're just looking for this breakdown below where we're at here, getting below that wave 1. That gets us a minimum expected wave 3 down here at around 54.70. So we'll see how things continue to play out. But locally, That wave 3 is going to be a little bit higher than 79.60. But no reason with anything that's going on at the moment to think that that anything different is going to happen right here. Again, remember, we've been rallying, straight up rallying, guys, since May of 2020. That's almost 2 years, guys. Next month, it'll be 2 years since we had that breakdown and crash down into the negative numbers. So the idea that we're going to continue up toward 300 a barrel, as some analysts are talking about, without some kind of healthy, strong pullback after such a strong rally is just asinine. It doesn't make sense if you think about it. So, remember the all-time high here on WTI crude here is the 11th of July, 2008. That was that 147.27. And so when it hit that, we had this kind of thing happen. Here we are again up in that level. So for now, anyway, it seems like a very important, that 140, 150, 130 kind of area seems like very important as far as, resistance goes. So we'll see how it does continue up there, okay? Let me see here. So as far as, the stock market goes, right? So we always look at that. So this is the NASDAQ composite here. Again, it had on the CPI report, it gapped up at the open, rallied right up here, filled in this gap, and look at that afterward. Continues to fall off now. Knee-jerk reaction. Wave 3 has a minimum expected target down here of 12,781. Now remember, that's highly technology driven. The S&P, these are the E-minis. The S&P is still pretty high technology, but nowhere near like the NASDAQ, right? So they did their thing, rallied into this previous area of resistance right here, getting dropped. So, again, still looking for a minimum expected target down here, wave parentheses 3 down here at around 42.8325. It's possible this is maybe 1, 2, 3, 4, or 1, 2, 3, 4, 5. So this may be wave 1 of 3, and in which case this would be wave 2 of 3, and wave 3 is going to end up actually lower. But for right now, that target still stands right there. Of course, if you're in Discord, I update this one twice a day, morning and night. And so, I'll update my thoughts on that when I can have some time to really kind of look at it. Dow Jones is the most broad-based of the three. It does have some, technology in it, but very, very little. It's much more broad-based than what the other ones are. So it looks a little different because not all sectors, it's not like so much the overall index being driven by what's going on with technology, right? So right here, small gap up and then a rally right into the pivot, the 1 hour pivot. Immediate rejection, sent back down. A little bit push up into that wick, as I often talk about, we get, and continuing to fall back down now. Wave 3, minimum expected target down there, 33.031. Again, depending on if you're looking at the NASDAQ composite, which had looks like the top's in there in November, or E-minis and Dow, which looks like the top's in there at the beginning of January. Anyway you're looking at it, looks like the top is done. It looks like we've got a wave 3 setting up. If I'm correct, and we do have a large wave 3 setting up, we can expect a pretty significant move down. So again, 1, 2, 1, 2. So this would be 3 of 3. And as you know, an Elliott wave, or maybe you don't, I discuss it often, your 3 of 3s are your really powerful waves. That's when everybody gets involved. And those are when you see the strong, big moves. So, in terms of structure here, you can see we broke out, came back, found support right here on this previous area of resistance right here. So we'll break down through that, get you through here, and then it should just free fall after that as we're looking at it, okay? I realize, guys, especially if you're new, a lot of what I say goes completely against what your big pundits and whatnot out there are talking about. But all I can say about that is, the way I look at the market has served me extremely well. I've been a lot more correct than I've been wrong, especially with the large movements and what's going on across all the markets. And does that mean I'm going to continue to be correct? No, it doesn't. Not at all. But until I see some consistent areas of where I'm wrong consistently using this way that I look at the markets, until we see that, there's no reason to change the way that things are looking. As a matter of fact, like I said, we look at things like what is the Fed going to do. I talk about these things a year out, and they happen. And again, it isn't for me. I always get somebody that's that thinks this is about me, kind of just being all whatever, right? Just trying to impress people. It's not that. What I'm trying to say is there's a certain way that I look at the markets that seems to work. And so I have a history of these things working out. And so that's why I discuss them the way I do. But nothing is ever a guarantee, guys. Don't ever think anything's a guarantee in the markets, okay? Even if I were to be correct the next 10 times with everything I said, it doesn't mean I'm going to be correct the 11th time, okay? And so again, risk management is always the most important thing you ever do as a trader. It's the most important part of trading. Proper risk management, because that way you protect yourself from yourself. If you're not doing it, you've probably already understood it. You blow up your account. You lose a lot of money in a single trade. Many times it happens when you've already been up in profit pretty well and you didn't take profit, right? So, it's like insult to injury. So not only do you not get to take that profit because you didn't, but now you got to take some huge loss, right? So I'm trying to hopefully remind you guys enough about risk management that doesn't continue to happen if that's been something that's happened to you. Happened to me a lot when I first started, first few years trading. So, yeah, I still remember. It stung. It hurt. But yeah, so, again, guys, it's pure price action off charts and an understanding in the way that I do of what happens, with social mood. So we'll see if I'm right. So far, so good. I say so good in just in that we've been able to trade pretty effectively. Generally, it's been wrong sometimes. It is what it is. It's part of being a trader. But overall, the themes remain, that a top may be in. Again, things are at extremes with people with their hyperinflation talk and, things like that. So that's usually a good indicator that the top may be in as far as that goes as well. But it doesn't mean, that it ends tomorrow or anything. Again, these are big macro ideas that take a little time to play out. Like I said, I see core inflation probably sticking up, 6% or a little bit more through, Q4 of this year. So, through October at least. But then I think, if it does, I think then we start seeing all that inflationary price reaction kind of working itself through the system as we get toward that point. And then should expect things to kind of fall off there. So, yeah, man. I mean, I hope, I hope all this makes sense, guys. My goal here is to give you a broader understanding of the markets in general, and to hopefully counteract a lot of the emotional things that you see in social media. Again, it doesn't mean you have to believe me, guys. But if you're at least considering and thinking about it, it means you won't be completely drawn in by the emotional pleas going on with your, sometimes usually your larger accounts in social media that often, result in what you would expect with emotional trading losses, right? So anyway, there we go, guys. I'm going to get out of here. I'm still short, just so you guys know. We've been talking about this a while. I'm still short the Euro USD from opening price 1.10967. Still looking for it to go a little bit lower. The last week has been slow. We've been kind of sideways. It came down a little bit last week, but overall sideways here since the end of last week. About 260 pips in profit right now. So, again, that has a lot to do with what's going on with the dollar. The Euro USD is usually pretty close to a mirror reproduction of that because the Euro USD makes up 58% or whatever of the DXY weighted value. So, continue to ride this a little bit lower, maybe 300, 350 pips, and then I think we'll potentially be bottomed out around there. And then, I'll take those profits and go long on a bounce. Okay? So that's where I am. Yeah, I tell you what, I almost took, I saw a couple opportunities here to take some profit, and I'm just like, no, I'm in this already here. I just keep writing it down. I closed out that other one at 209.88 pips back on the 30th of last month. After it did come down and then it went back up and made a little bit higher high there on that larger count. So it didn't quite get down 400 like I was looking for at that time. But I did lock in on, almost 210 pips there. And then also that day, earlier in that day, I locked in another 187 pips on that with another short. So I had a short that went up, took profit, had another, quicker short come down. So, yeah, I guess I racked in. The 210 was the one that was sitting there for a while. Well, I guess it was only sitting there for a day. Because the private one before that was, I'd locked in 69. Oh, wait a minute. No, I'm not. No, I'm not. I'm sorry. Those are definitely the days they happen. I got to see what those profits were, though. What the pips were on that. Forex.com doesn't exactly give you all that information right up. I've got to look through the order history. Nonetheless, what I meant is that I did write it down, as I had mentioned previously. Was looking for the 400 on the drop. Finally got out, as it rallied back up. Got back in then. That's where I'm sitting at now from that 1.10967. So, it's been a long day, guys. Catch up, what's up, man? It says, don't you think we can have a last positive wave before the Fed had no choice to crash the market by increasing the rate of you're talking about 50 basis points? I don't think the Fed crashes the market. Again, I told you, I think we're already in that direction. I think things are already in play. The Fed is reactionary. Now, do I think we have a last positive wave for what, though? Are you talking about stocks? Are you talking about Euro USD? I don't know. If you're talking about stocks and all that, again, I think we're probably topped out. I can't guarantee it, but, the market, as I explained, it looks like we are headed further down. Yeah, stocks, yeah. And not all stocks go down. It's like everything else. You've always got outliers, things that don't follow through with the general trend. But in general, I believe stocks are potentially topped out here. So I just want to see it kind of falling down lower to keep confirming. But for right now, nothing's happening in stocks that make me think it's going to head up higher there. All right? If it does, I'll talk to you guys and I'll let you know what my thoughts are. But until we start getting, in stocks, some major movement above the wave twos, then it might be like, okay, maybe. But, without an actual breakout above the all-time high and with continued pressure coming down, it seems like we want to head lower. So we'll see, right? All right, guys. Hey, listen, I appreciate you guys checking in. As always, remember, the only thing you control in the market is how much you lose, all right? So keep working with it. The only other real generally actionable advice I can give you guys is look for your higher confidence trades, okay? Don't enter a trade because you're emotional and there's a chance. Look for your validation levels, okay? Right now, if you're looking to, I've talked to a lot of people who've been trying to buy these dips on the thought that it was the bottom and heading up. But, I often, I always talk to you guys like I did today. Where are your validation levels? Where do you increase your confidence at? You have to know those. You have to wait till price pushes through those. If the bottom's going to be in on this, it's got a lot further to go up, guys. Don't worry about trying to catch that absolute lowest price. Take more care in just trying to eliminate as much as possible the idea that you may be wrong. Because even if you're using proper risk management, when you're wrong, you're still wrong. You still lose money. Money still needs to be made up before you can go further in, right? Before you can make further profits. So one, proper risk management is important. But beyond that, make sure you're looking for your higher confidence trades, guys. Don't get in just because there's a chance and you're emotional. All right? I hope I see you guys over in Discord. If you do, please, chat out there, say hi. We'd love to welcome you in. You've seen a lot of our members or some of our members in here. And they're just absolutely fantastic people that you'll see there in Discord talking a lot and whatnot. But if not, as always, I'll be back on Friday at 11 a.m. Central Standard Time. So hopefully you guys will join back then, all right? You guys have a great week. Trade safe. And I will see y'all, well, in Discord or on Friday. Take care.